It's March 2020. The world is shutting down. The stock market is in absolute free fall, the fastest crash in history. Trillions of dollars wiped out in days. Investors are panic selling everything they own. And Warren Buffett? He's sitting in his modest office in Omaha, Nebraska, eating a McDonald's breakfast, drinking a cherry Coke, and doing absolutely nothing. No selling. No panic. No calls to his broker. Just nothing. And here's the crazy part, that nothing has made him one of the greatest investors in human history. Today, we're going to find out why Warren Buffett almost never sells his stocks, the brilliant strategy behind it, and what regular investors like you and me can actually learn from it. Let's get into it. Before we talk about why Buffett doesn't sell, let's quickly establish who we're even talking about, because the numbers are almost unreal. Warren Buffett started investing at age 11. He filed his first tax return at 13. By the time he was 30, he was already a millionaire. Today, at 93 years old, he's worth over $130 billion. But here's what people miss. Roughly 99% of his wealth was built after his 50th birthday. That's not luck. That's not a hot stock tip. That's a very specific, very disciplined philosophy, applied consistently for over 70 years. And at the core of that philosophy is one deceptively simple idea. Buy wonderful businesses. And then, don't sell them. Sounds easy, right? Spoiler, it's not. Buffett doesn't just buy any stock. He's famously picky. He's looking for what he calls a wonderful business at a fair price. And the keyword there is wonderful. So what makes a business wonderful in Buffett's eyes? 3 things. Number 1, a durable competitive advantage. Buffett calls this a moat, like the water around a castle that keeps enemies out. It's whatever makes a company impossible to compete with. For Coca-Cola, it's brand loyalty so deep that blind taste tests don't even matter. For Apple, it's an ecosystem people literally can't leave. For American Express, it's decades of trust in financial services. Number 2, a business he can understand. This is why Buffett famously avoided tech stocks in the dot-com era. He said, "I don't invest in what I don't understand." While everyone else was throwing money at companies with no earnings, Buffett stayed in his lane. Number 3, management he trusts. He wants honest, capable people running the company. Because when you're planning to hold a stock for decades, the people in charge matter enormously. Once Buffett finds a business that checks all 3 boxes, he doesn't want to sell it. Ever. Because finding a truly wonderful business is rare, and once you have one, selling it is almost always a mistake. Okay, here's a part of the never sell strategy that most people completely overlook, and it might be the most financially brilliant piece of the whole thing. Taxes. In most countries, including the US, you only pay capital gains tax when you sell a stock. Not while you hold it. So let's say Buffett bought $10 million worth of Coca-Cola stock in 1988. That stock is now worth hundreds of millions. If he sells it, he owes the government a massive tax bill. We're talking potentially 20% or more of those gains gone. But if he never sells? He never pays that tax. That money stays invested, compounding, growing, year after year after year. Buffett himself has called deferred taxes essentially an interest-free loan from the government. Think about that. Every year you don't sell a winning stock, you're keeping money in your portfolio that you would have otherwise handed to the tax man. And that money keeps working for you. Over decades, this tax deferral alone can account for an enormous difference in final wealth. Selling isn't just emotionally costly. It's mathematically costly. Albert Einstein, allegedly, once called compound interest the 8th wonder of the world. And Buffett has built his entire fortune on this one concept. Here's the simple version. When your money earns returns, those returns start earning returns. And those returns earn returns. It's a snowball effect, and it needs time more than anything else. Let's put some numbers to it. Say you invest $10,000 and earn an average of 10% per year. After 10 years? You have about $26,000. After 20 years? About $67,000. After 30 years? Nearly $175,000. After 40 years? Over $450,000. From a single $10,000 investment. No additional contributions. Notice how the growth explodes in the later years? That's the magic of compounding. It rewards patience more than intelligence. More than timing. More than picking hot stocks. Every time you sell a winning stock, you reset the snowball. You start over. You lose all that future compounding. Buffett understood this at age 11. Most people never fully grasp it at any age. Now here's where things get really hard. Understanding the strategy is one thing. Actually following it when your portfolio is down 30%, 40%, 50%? That's a completely different challenge. In 2008, Berkshire Hathaway's stock dropped over 50%. Not some small company, Berkshire Hathaway. Buffett's own company. Did he panic? Did he sell? He wrote in his annual letter, "We enjoy such price drops if we have funds available to increase our positions." He saw a crash as a sale at the store, a chance to buy more of something great at a lower price. This is the psychological edge that separates Buffett from almost every other investor. While the entire world is wired to feel pain when prices drop and euphoria when prices rise, Buffett has trained himself to feel the opposite. He's not emotionless. He's just disciplined. There's a famous Buffett quote: "The stock market is a device for transferring money from the impatient to the patient." Every time a nervous investor sells during a crash, someone like Buffett is on the other side of that trade. Buying. Now, to be completely fair, Buffett is not a robot. He does sell stocks sometimes. In 2020, he sold all of Berkshire's airline holdings: Delta, Southwest, United, American. He admitted he was wrong about the industry's future post-COVID. He's also trimmed positions in Apple, sold out of banks like Wells Fargo over time, and exited businesses that no longer had the moat he originally saw. So when does Buffett sell? 1. When the business fundamentals have permanently changed. Not a bad quarter. Not a bad year. But if the underlying reason he bought the stock no longer exists, the moat is gone, management betrayed trust, the industry is disrupted, then it's time to go. 2. When he finds something significantly better to do with the capital. If opportunity A is outstanding and opportunity B is extraordinary, he'll make the trade. 3. When he made a mistake in the original analysis. Buffett is remarkably honest about this. He says, "If you find yourself in a hole, stop digging." Notice what's not on this list: short-term price drops, bad news cycles, market crashes, analyst downgrades. He sells on business logic, not market emotion. That's the key difference. Okay, so you're probably not managing $100 billion. You don't have Buffett's research team, his connections, or 70 years of experience. Does any of this apply to you? Absolutely, but with some honest nuance. First, you don't have to buy individual stocks to apply this philosophy. Buffett himself has said that for most people, a simple low-cost index fund, bought consistently over time and never sold during panics, is the smartest strategy available. That is buy and hold. Applied to the whole market. Second, the enemy is emotional trading. Studies consistently show that the average investor earns significantly less than the market, not because they picked bad stocks, but because they sold during dips and bought during peaks. Checking your portfolio every hour and reacting to headlines is the single fastest way to destroy long-term returns. Third, time in the market beats timing the market. Every study on this comes to the same conclusion. The investors who win over 20, 30, 40 years are the ones who stayed invested, not the ones who were clever about when to get in and out. You don't need Buffett's genius. You need his patience. And that? You can actually develop. Before I let you go, I want to leave you with one question, the question Buffett reportedly asks himself before every investment. Would I be comfortable holding this if the market closed for 10 years? Not 10 days. Not 10 months. 10 years. If the answer is yes, If you believe in the business that deeply, then you've probably found something worth owning. If the answer is no, if you're buying it because it's trending, because someone on social media said so, because you think you can flip it quickly, then you're speculating, not investing. That one question alone could save most people from their worst financial decisions. Warren Buffett's never sell strategy isn't about stubbornness. It's not about ignoring reality. It's about the deep understanding that truly great businesses, bought at fair prices, held with patience through every storm, are among the most powerful wealth-building tools that have ever existed. The market will crash again. Analysts will panic again. Headlines will scream at you to sell. And Buffett will be in Omaha, eating a cherry Coke, doing nothing. If you found this valuable, hit subscribe. We break down investing ideas like this every single week. Drop a comment below. What's one stock you'd be comfortable holding for 10 years? I'd love to know. See you in the next one.